you all are doing well. So today we're going to be talking about regulatory environment, which is the first topic in advanced audit and assurance. So the first thing is international regulatory frameworks for audit and assurance services. It covers 3 points. Firstly, they want you to explain the need for laws, regulations, standards, and other guidance related to audit, assurance, and related services. So first of all, I have covered the need for assurance services. It talks about how assurance professionals provide reports, they give independent opinions, and as a result of which it enables auditors to make more informed decisions. Then we're talking about regulations, which are of four types: ethics, standards, regulations, and statutory requirements. The International Regulatory Framework for Audit and Assurance Services encompasses International Federation of Accountants (IFAC). In addition, other boards includes there are two more boards, IAASB and PIOB. The full forms are mentioned here, and their roles are also mentioned. Okay, now coming to the second part, outline and explain the need for legal and professional framework, including public oversight of audit and assurance practice, the impact of corporate governance principles on audit and assurance practice. So, first of all, we're going to talk about public oversight and audit assurance practice. What does public interest oversight boards do? So, they have multiple responsibilities. I have listed four of them. Overseas IFACs auditing and assurance believes standards should be high quality, clear, and usable. Ensures auditors act independently of personal interests and be responsive to emerging needs of standard users. Promote compliance with IFAC standards by member bodies of IFAC around the world. Corporate governance system of rules, practices, processes by which company is directed and controlled. It is about ensuring public companies are managed effectively for the benefit of the company and its shareholders. So then we're talking about corporate governance. So the first part was about the public oversight of audit and assurance, and then it's about impact of corporate governance principles on audit and assurance. So, why there is a need for corporate governance: manipulation of share prices for personal gain, disguised poor results, mismanagement, extraction of funds from the company, raising finance fraudulently. What are the six OECD principles? Ensuring the basis and effective corporate governance framework, the rights and equitable treatment of shareholders in key ownership functions, institutional investors, stock markets, and other intermediaries, the role of stakeholders in corporate governance, disclosure and transparency, the responsibilities of the board. Also, the fact that the code is split into five parts. These are the five parts. And if you guys need more details, then you can refer to the book, The Study Text of AAA by Kaplan. Last point that comes under the framework of this heading, International Regulatory Framework for Audit and Assurance Services, talks about discussing the role of audit committee and its impact on audit assurance practice in relation to two things: the relationship with external auditor, including the appointment, removal, and monitoring of effectiveness, and the oversight and approval of provision for non-audit services. So firstly, we're going to talk about the objectives of the audit committee. So, audit committees form part of governance structure of an organization. At least one member of the audit committee should have recent and relevant financial experience, and there should be three non-executive directors. And if the company is small, then two. These are the objectives of the audit committee, and these are the advantages. Objective includes financial reporting. It is to increase public confidence and to make public belief that the audit department is independent of the company, to assess directors meeting in their financial reporting, to review the company's system and internal controls, to strengthen the position of internal audit. And what are the outcomes of it? The advantages: that the reporting is independent, there are internal controls in place, the communication is better, and it is also easier and cheaper to arrange finance, as the presence of audit committee can give perception of good corporate governance. It would be less burdensome to meet listing requirements of an audit committee is already established. The quality of management accounting will be improved, as audit committee is better placed to criticize internal functions. There could be a few drawbacks also, like NEDs may be overburdened with detail. Executive directors may perceive it as a threat to their authority, and difficulties in recruiting non executive directors who have relevant skills, experience, and sufficient time to become effective members of the committee. Why should the external auditor first speak to the audit committee? So, these are the few of the reasons that the external auditor gets to know what the audit committee is up to, what are the things that are happening, and also at the same time, the audit committee will have more time to review the effectiveness and efficiency of the work of the external auditor than the board. The committee can therefore make recommendations on the appointment of the auditor and recommend a different firm if this is appropriate. Then there is something about non-audit services, like it was mentioned here, the oversight and approval of provision of non-audit services. So here it is. Anyone in the audit firm considering providing a non-audit service to one of the firm's audit client must communicate the details to audit engagement partner. So there's no conflict of interest. Before accepting non-audit work, consider whether a reasonable and informed third party would regard the non-audit work as impairing the firm's objectivity and independence. Where safeguards are insufficient to mitigate the risk or to independence, the non-audit work should not be accepted. General safeguards for non-audit services include separate terms for audit and non-audit work and engagement quality review of the work and conclusions of the audit team in relation to non-audit service. An audit firm cannot accept an additional service where it would require a firm or covered person to play any part in management decision taking of the entity, because then it will expose them to the self-interest threat. Prohibited audit services. So an external auditor cannot provide the services of an internal auditor. Information technology services related to financial information, because again self-review threat and self-interest threat. Valuation services for listed clients, where the valuation would have a material effect on financial statements, and for non-listed clients, which would involve significant subjective judgment and has a material effect on financial statements. Tax services to promote tax structures, provide tax advice, involve taking on management role, or would involve acting as an advocate for the entity in the resolution of an issue. Litigation support legal services, where the outcome of a pending legal matter, recruitment and remuneration services, advice on tax, pensions, and interpretation of accounting standards. Corporate finance services, including financing, investment strategy, and promoting dealing or in underwriting shares. Reconstructing Restructuring services, which involve taking on management role, accounting services such as bookkeeping, preparing accounting records or financial statements, and payroll services. So these are some of the non-audit services that are prohibited. The next video is going to cover all the key areas on money laundering. So if you have any queries, if you need to ask any questions, you can comment below and I will respond. Thank you.